Welcome back to the podcast, everyone. Today we have a massive episode ahead of us. We are diving deep into the JP Morgan Asset Management 2026 Year-Ahead Investment Outlook. And Joe, looking at this report, the title really sets the stage: AI Lift and Economic Drift.
It really does, Jane. It captures the tension we are seeing perfectly. On one hand, you have this incredible technological rocket fuel in the form of artificial intelligence lifting specific sectors and driving massive capital expenditure. But on the other hand, the broader economic boat is just sort of drifting. It's not sinking, but it's moving in very strange currents.
Strange currents indeed. I read through the executive summary, and the term that jumped out at me immediately was K-shaped economy. We've heard this before, but it feels more pronounced now. Can you break that down for us?
Absolutely. So imagine the letter K. It has a vertical line and then two arms, one pointing up, one pointing down. That is exactly what the U.S. economy looks like as we head into 2026. The arm pointing up represents the wealthy, the asset owners, and the corporations tied to this AI boom. The stock market has had 3 consecutive blockbuster years, Jane. If you own stocks, you feel rich. You're spending on high-end services, luxury goods, and travel.
And the arm pointing down?
That's the middle income and lower income consumer. They are getting squeezed. They don't have that asset cushion. They are facing the brunt of inflation, which, while cooler than 2022, is still biting. And crucially, rate-sensitive sectors like housing remain, to use the report's word, soggy. So beneath the surface of a decent GDP number, you have 2 completely different lived experiences.
That makes sense. It's like looking at a calm ocean surface, but underneath there are 2 currents moving in opposite directions. Now, let's talk about the timeline. The report mentions a bit of a roller coaster for GDP. Slow in late 2025, heating up in early 2026, and then cooling again. What is causing that weird rhythm?
This is where we get into the weeds of policy, specifically something called the OBBBA. The legislation provided for full expensing of spending on equipment and R&D, plus new tax breaks for households that technically started in 2025.
Okay, hold on. If the tax breaks started in 2025, why are we seeing the impact in 2026?
Great catch. This is a classic bureaucratic delay. The IRS hasn't adjusted the income tax withholding schedules yet, so people have been paying taxes as if those cuts didn't exist. When they file their taxes in early 2026, they are going to get a bumper crop of tax refunds. It's like finding a wad of cash in a winter coat you haven't worn in a year.
I love finding money in my coat. So early 2026 is the sugar high from these refunds?
Exactly. That refund money hits bank accounts, consumption spikes, and GDP growth jumps to above 3% in the first half of the year. But, and this is the drift part, sugar highs wear off. Once that money is spent, we expect growth to slow back down to between 1% and 2% later in the year.
Okay, that explains the growth spike. But there are headwinds too, right? The report spends a lot of time discussing tariffs and immigration.
Those are the 2 big brakes on the car. First, tariffs. We've seen dramatic increases in U.S. tariffs, generating huge revenue for the government, over $29 billion recently. Up until now, retailers have been eating those costs. They've been absorbing them to keep prices competitive.
But they can't do that forever, surely.
No, their margins are too thin. So in 2026, we expect those costs to be passed on to you and me. That pushes inflation up and drags real consumer spending down. It's a direct tax on consumption.
And the immigration piece, the report mentions a crackdown.
Right. The data here is spotty, but the trend is clear. Net immigration is dramatically declining. In fact, we might see an absolute decline in the working age population. This creates a fascinating dynamic in the labor market. Usually when growth slows to 1%, you see layoffs. But because companies know labor is scarce, they are hoarding workers. They aren't hiring new people. Job growth is slowing to maybe 50,000 a month, but they aren't firing anyone either.
So it's a low growth, low layoff environment. That feels stagnant. Let's pivot to the Federal Reserve. The report describes a divided Fed. What is going on inside the central bank?
It's getting spicy at the Fed, Jane. Usually they present a united front, but we are seeing a wide divergence in views. You have the hawks, who are terrified of inflation. They look at the tariffs and the OBBA stimulus and say, we cannot cut rates too fast. Inflation is going to spike.
And the doves?
The doves are looking at the drift. They see the slowing job growth, the soggy housing market, and the struggling low-income consumer. They argue that if rates stay high, we will crash the economy.
This division means policy is going to be slow and cautious. The report expects the Fed to reduce rates maybe 2 or 3 times through 2026.
Okay, Joe, explain this to me like I'm 5. If the Fed is cutting rates, shouldn't that be good for bonds? But the report warns about volatility and advises us to be nimble. Why isn't it straightforward?
Imagine you're trying to walk down a staircase. That's the interest rates coming down. But the staircase is shaking because of an earthquake. That's the market volatility caused by inflation fears and policy fights. Even if the direction is down, the ride is bumpy.
That's a vivid image. So how do I invest in that shaking staircase?
You don't just bet on the direction. You focus on the income in fixed income. The report emphasizes locking in yields. Short-term treasuries are yielding around 3.5%, and 10-year notes are between 4 and 4.5%. That is a healthy return just for showing up. You don't need to gamble on huge price appreciation. You just need to collect the coupon.
The report also mentioned duration management. Can you unpack that jargon?
Sure. Duration is basically a measure of how sensitive a bond is to interest rate changes. A long-duration bond, like a 30-year bond, is like a seesaw with a very long plank. A tiny move in interest rates at the center causes a huge swing in the price at the end. A short-duration bond is a short plank, less movement. The report suggests balancing the two. Don't go all in on the long, risky seesaw, but don't hide entirely in cash. Be in the middle, or use active managers who can jump between the two as the volatility flares up.
Got it. So don't try to be a hero with interest rate bets. Just take the yield. Now, let's move to the sexy part of the report, equities and AI. The million-dollar question. Is it a bubble?
This is the debate of the decade. The valuations are high, no doubt, but the report makes a critical distinction between this AI boom and the dot-com bubble of the late 90s.
I remember the dot-com burst, pets.com and all that. How is this different?
In 1999, companies were being valued on clicks and eyeballs. They had no profits. Today, the companies driving this rally, the Magnificent Seven, are cash-printing machines. They have free cash flow margins near 20%. They are funding this massive AI build-out with their own cash, not debt.
So the foundation is stronger.
Much stronger. Think of it like this. In the 90s, we were selling tickets to a theme park that hadn't been built yet. Today, we were building the railroad. The massive capex, spending on data centers, chips, energy, is real infrastructure. Even if the AI software takes time to perfect, the data centers are physical assets that are being utilized. That's not vaporware.
But the report does mention risks. It says expectations have ratcheted higher. What happens if these companies stumble?
That is the danger zone. When you are priced for perfection, anything less than perfect is a disaster. If a major AI company misses earnings, or if there is a power supply crunch, because these data centers eat electricity like crazy, we could see a sharp correction. The report warns that the S&P 493, that is the other 493 companies in the index, need to start pulling their weight.
The S&P 493. I like that. It sounds like a forgotten sibling. Are they going to catch up?
They should. We are expecting earnings growth to broaden out. Sectors like financials are looking good because of deregulation. And as the AI ecosystem expands, it goes from the innovators, the chip makers, to the adopters. Healthcare companies using AI to find drugs, banks using it for fraud detection. That is where the opportunity lies for the rest of the market.
Speaking of opportunities outside the big tech names, the report is surprisingly bullish on international equities. It says, not lost decades international markets. Why the change of heart?
For the last 10 years, betting against the U.S. was a losing trade. But the gap is narrowing. There are structural changes happening overseas that people are ignoring. Look at Japan and Korea.
The report mentions shareholder-friendly policies there. What does that actually mean?
It means they are finally acting like capitalists. For decades, Japanese companies would hoard cash. They wouldn't pay dividends. They wouldn't buy back stock. The government has pushed hard to change that corporate governance. Now, buyback announcements in Japan and Korea are surpassing the U.S. relative to market cap. They are returning money to investors. That creates a floor for stock prices.
And Europe? Usually we hear about Europe struggling with low growth.
Europe is interesting because of the fiscal spend. Unlike the austerity of the 2010s, European governments are spending big on defense and infrastructure. Plus, European companies are cheap.
The valuation discount compared to the US is massive. If you want value, you look at Europe. If you want growth, you look at the US. But a balanced portfolio needs both.
Let's shift gears to alternatives. The report discusses private equity, private credit, and real estate. One thing stuck out to me: diversification isn't dead, just different. What's happening in the private markets?
Private markets are becoming the engine room for the AI revolution. The public market sees the chip makers, but the private market is funding the energy grid upgrades and the physical data centers. The report also highlights venture capital. If you want to find the next NVIDIA before it goes public, you have to look at VC.
But isn't private credit risky? I heard about some defaults recently.
There were some headlines about defaults, specifically in the auto sector, but the report emphasizes that these are idiosyncratic, which is fancy finance speak for isolated cases, not a systemic collapse. Private credit spreads have compressed, meaning the easy money has been made, but it still offers a premium over public bonds. You just have to be pickier about the quality of the borrower.
And real estate. I feel like everyone has been terrified of commercial real estate since the pandemic.
The fear is receding. The report notes that the NCRIEF index, a major real estate benchmark, posted positive returns across all sectors recently. We are finally getting clarity on hybrid work. We know offices aren't going to zero, but they aren't going back to 2019 levels either. The repricing has happened. Now you can buy assets at realistic values. And in residential, supply is so constrained that rents in urban centers are growing. It's a classic supply and demand story.
So buying when there is blood in the streets, essentially.
Exactly. Being contrarian when the fundamentals support it.
Joe, before we wrap up, I want to talk about the risks. The report lists a few scary scenarios. The Supreme Court ruling on tariffs, potential tariff rebate checks. What should we be most worried about?
The biggest risk is policy uncertainty. For example, the president is using the International Emergency Economic Powers Act of 1977 to impose these reciprocal tariffs. If the Supreme Court strikes that down, the administration has to scramble to find new legal avenues. That creates chaos for businesses. They don't know what their costs will be next month.
And the tariff rebate checks?
That's a potential inflationary bomb. If the economy slows down before the midterm elections, Congress might send out checks to consumers, funded by tariff revenue, to boost spending. That sounds nice, but it would reignite inflation right when the Fed is trying to cool it down. It's like pouring gasoline on a smoldering fire.
Okay, that is a lot to digest. Let's bring it all home to portfolio construction. The report uses a sports analogy, getting back on sides. What does that mean for our listeners?
Think of a soccer or football game. If you are off sides, you are in the wrong position relative to the action. You can't participate in the play. For the last few years, if you didn't own U.S. large-cap growth stocks, you were off sides. You missed the game.
So getting on sides means buying more NVIDIA?
No, it actually means the opposite now. It means realizing that the game is moving to other parts of the field. The on-sides position for 2026 is a diversified one. It means having enough fixed income to capture that yield we talked about. It means having exposure to international markets to catch the valuation gap closing. And it means using alternatives to lower your correlation to the stock market.
So stop chasing the ball where it was and move to where it's going.
Precisely. The report says diversification isn't dead, just different. The easy trade of just buy the S&P 500 might not work as well in a year where growth is 1% and inflation is volatile. You need active management. You need to pick the winners in credit. You need to pick the countries with reform momentum.
It sounds like 2026 is going to be a year for the active investor, not the passive coaster.
100%. It's a year to be nimble, to watch the Fed, watch the tax refunds, and watch the earnings reports of those S&P 493 companies.
Joe, this has been an incredible deep dive. If you had to sum up the 2026 outlook in one sentence, what would it be?
I'd say enjoy the AI lift, but keep your life jacket on for the economic drift.
I love that. Enjoy the lift, prepare for the drift. Thank you, Joe, for breaking this all down. And thank you to our listeners for tuning in to this analysis of the JP Morgan Asset Management Outlook.
Thanks, Jane. Always a pleasure.
We'll see you next time. Stay diversified.
And stay on sites.
Wait, Joe, before we cut, I actually have one more follow-up on the Fed. We skipped over something interesting in the report about the neutral rate. Can we touch on that?
Oh, absolutely. That is crucial. So, the neutral rate is the theoretical interest rate where the economy is neither speeding up nor slowing down. It's the Goldilocks zone.
Like cruising speed on the highway?
Exactly. If you go faster, you overheat, inflation. Slower, you stall, recession. The debate right now is that the Fed believes the current rate is restrictive. It's tapping the brakes. But the market is pricing in so many cuts that it implies the neutral rate is much lower than it might actually be.
So if the neutral rate is actually higher, say 3.5% instead of 2.5%, the Fed can't cut as much as people hope.
Bingo. And that is where the disappointment could come from. If investors are betting on rates going back to 0 or 2%, they're going to lose money. The new normal is likely higher rates for longer, simply because the economy has structurally changed with all this fiscal spending and AI investment. The cruising speed has increased.
That connects back to what you said about volatility. The market expects one thing, the Fed might deliver another.
And that mismatch is where the volatility comes from. It's also worth noting the political pressure. The report mentions Stephen Mirren's interim governor seat expiring in January. New appointees are likely to favor easier money, but the Fed terms are staggered, so you can't just flip the board overnight. The institutional inertia protects the Fed's independence, but the pressure will be immense.
It's a chess game between the market, the Fed, and the politicians, and we are just trying to figure out where to put our savings.
Which brings us back to quality. In a chess game like this, you don't make wild gambits. You protect your pieces. High-quality corporate bonds, profitable tech companies, and diversified assets. That's your defense.
Okay, now I feel like we've truly covered the bases. Thank you for that addendum, Joe.
Anytime. It's the details that matter.
All right, that's a wrap for real this time. Thanks for listening.